Good day, everyone. Our lesson today is about journal entries, and to illustrate journal entries, we'll be using this particular illustrative company, and the name of the company is Sample Services. So, Sample Services has this chart of accounts used in the recording of transactions and events. So as you can see from here, the chart of accounts, of course, has the account codes and the account titles, and of course you have them here, everything from cash up to the expense item. We have the depreciation expense with a code of 70. So this will be the guiding chart as to what account titles will be used, because remember, when it comes to the accounts to use, the company has to refer it to the chart of accounts. Like for example, if the transaction is rental, then the company obviously has to recognize rental expense or rent expense. So an account title like rental expense or rent expense are both equally applicable, but again, once the company has already established a chart of accounts like this one here, so it is clearly that the company will have to use rent expense and not rental expense, because in the chart of accounts, the account title used is rent expense. So that is the very reason why chart of accounts is to be established, so that the company can have uniformity of the account titles to be used. But of course, for journal entry purposes, when a particular sample quiz or an assignment case will be given, and there's no chart of accounts presented, then of course when you make journal entry, then you can use an account title that is applicable to a particular transaction. Like what I have said a while ago, if the transaction is rental, you can use either rent expense or rental expense at your own choosing. But again, once there is chart of accounts given, then you really have to strictly follow what is provided in the chart of accounts. Okay, so that is the number one thing to remember. So now we can proceed to our transactions so that we can begin making our journal entries when it is required on that particular transaction or event. So again, we have here Sample Services had these transactions during January, from January 1 to January 31. And this is quite a long case, and it extends up to February. And we also have the transactions here for February, and that is also up to the end of the month of February 28. So all of them are the transactions of this company, and we are going to use them for our discussion on journal entries. Okay, so anyway, we have those as the summary of the transactions. So now we'll take them up one by one. So we have the January 1 transaction. January 1, Jackie, the owner, finalized his plans and strategies in the business that he is going to put up. So remember that the first step in the accounting cycle is not journalizing, but it is identifying. So we have here the identification or identifying stage. And based on this transaction, the finalization of the plans and strategies cannot be expressed into any of the elements of the financial statements. The elements, as we know, are the assets, liabilities, owner's equity, income, and expense. So being not able to identify this transaction as any of these five assets, liabilities, equity, income, and expense, this transaction therefore fall into that classification we call non-accountable event. So remember, an event for journal entry purposes can only either be accountable or accountable. If the transaction is accountable, then it will be journalized. But if the transaction is non-accountable like this one, it will no longer go through the next stages in the accounting cycle. It will stop here at identifying because it will no longer be journalized, and all other steps after that will of course no longer be made for that particular transaction, because again that transaction is non-accountable. So again, for accounting purposes, as stated here, it will not go to the next step in the accounting cycle, which is journalizing. This transaction, I have to emphasize, is very important for the business because these plans and strategies are very important in order for the business to succeed. But for accounting purposes, for the journalizing and the rest of the accounting cycle, since this one will not affect any of the elements, its importance is not lost. But again, I have to reiterate, since it cannot be converted into any of these elements, then it is considered non-accountable and therefore it will not be journalized. So that's the point there. Okay, so now we proceed to transaction number 2. Transaction number 2, hired an employee to work as assistant to the owner. So the transaction here is the hiring of employee. So again, the next thing to do is like what we did in the first transaction. We have to identify this, whether it is accountable or non-accountable, like what we did here. So again, we have to analyze it based on these elements. Can we convert this transaction number 2 into any of the assets, liabilities, owner's equity, income, and expense? And if the answer to that question is a yes, then it will be accountable. But if the answer to that question is a no, then like transaction number 1, it will be non-accountable. So after that, of course, after analysis, we would know that the hiring of the employee cannot be expressed into any of the elements in the financial statements. Therefore, like transaction number 1, again, transaction number 2 is another non-accountable event. So again, the hiring of the employee is a very important business event. Otherwise, the owner would have to do all the tasks on his own. But again, for accounting purposes, since the transaction, the hiring cannot be converted into any of the elements, then the hiring of employee transaction will stop here. As to the accounting cycle, will stop here in the identifying stage. It will no longer go through the next stages, especially journalizing as the next step, because again, it is a non-accountable event. So again, I would reiterate, the transaction is very important for the business, but for the steps in the accounting cycle, it will stop at the identifying stage. It will no longer go through the next stages. Okay, so now we go to January 3. January 3 transaction, Jackie transferred cash of 300,000 to the business as his initial investment. Okay, so now we do again the identifying analysis. In this transaction, what happened is that Jackie